Hi, this is Shail, Tonight, and Richard. We're going to talk a bit about our recommendation on the proposed acquisition of Sun Microsystems by Oracle. So, our view is that Sun Microsystems is a good acquisition in that it will add to the bottom line, allow Oracle to access new consumers, but we don't believe Oracle will be able to execute on the kind of grand vision of a one-stop shop for enterprise customers that Larry Ellison envisions, where you have fully integrated products, fully integrated hardware and software products. So unexpected synergies resulting from such an integration shouldn't be included in the valuation. From an earnings basis, Oracle has done this before on previous acquisitions. They can bring Sun Microsystems back into the green by cutting some fixed costs. There's open source software platforms that Sun Microsystems owned, like Solaris, that they can be immediately monetized, creating future income. Um, Also, MySQL will allow Oracle to expand into some of the lower end customer base and database management market. On a strategic basis, Oracle systems are already largely built on Java and Solaris, removing a lot of friction. They're beginning a foothold in the networking hardware market, which is a higher barrier to entry business with high switching costs. And adding Java and Solaris to their suite of software products would introduce a lot of potential for cross-selling and bundling among their clients. Our main issue is this vision for one-stop shop for enterprise customers, a kind of Apple for enterprise customers. Apple was not just a software company that bought a hardware company, or a hardware company that bought a software company. They developed all their products from the ground up, hardware and software in conjunction with one another. Um, Also, Oracle does not have that much experience in hardware. Another company that has failed to create any synergy between hardware and software through acquisitions is Google. They're the world's probably preeminent software company, and they haven't been able to create many synergies between all their hardware product investments. Um, and so we think this proves how difficult it is for a software company to just buy a hardware company and try to create the kind of highly profitable ecosystem that Apple has. As for the valuation approach, we recommend the discounted economic income method. The hardware market is a high barrier to entry business with stable, predictable cash flows, so we believe a discounted cash flow method is the best way to value Sun Microsystems. You can see here in the graph that even during the 2008 recession, the hardware market grew at a steady single digit pace, mid single digit pace, as opposed to the software and services market, which took a dip. In this graph, you can see that even though Sun Microsystems has some valuable IP and software, a majority of its revenue is still coming from its hardware products, and so we believe it should be valued as such. Now I'm going to hand over to Tzoni to hone in on some key metrics.
Thanks. Now I'm going to talk a bit about the multiples analysis and the economic fundamentals that went along with it. To compute the multiple analysis, we used sales, EBIT, and EBITDA, which were provided in Exhibit 9, which resulted in the following table. We integrated the averages into this table, as we found that they were essential when computing Sun Microsystems' enterprise value. To ensure an accurate analysis, we consider the following economic fundamentals: enterprise value, state of the economy, strength of the industry, and financial performance of the company. Now I'm going to talk about synergy and the sensitivity analysis. Synergies between Oracle and Sun Microsystems are their strategy, their industry, and ultimately the acquisition will allow Oracle to build its portfolio of products. And with the combination of the companies, the sales teams will grow as well. Moving on to the sensitivity analysis, we calculated the sensitivity analysis using the perpetuity method. And as you can see, the sensitivity analysis with synergies, price per share, we found at 1280. We saw the enterprise value at 7,630. Please mind that is in millions. And the equity value of 9,500. Also, please mind that is within million as well. Now I'm going to talk a little bit about the maximum offer price and how we got there. With their current offer price per share of $9.50 and the price per share with synergies at $12.80, we ended up taking the average of these two values. We did this as we did not want to misrepresent the value of Sun Microsystems, and taking the average was a safe way to go. All in all, after taking the average, we determined that $11.15 was the maximum offer price that Oracle should offer for Sun Microsystems. Thank you.
Hi, everybody. I'm Tzoni, and I will talk a little bit more about our financial analysis to back up our decision. We decided that the best approach to value Sun Microsystems was the discounted cash flow approach. We chose this approach because it is more objective than the comparable trading company approach. It determines the current value of the company based on how much it can make in the future. It also doesn't require any comparable companies. The capitalized economic income approach is an arbitrage version of this discounted cash flow approach. It is best used for a company that is stable and has an evenly growing economic income flow. Oracle should target a rate of return on the acquisition that is equal to the WACC, which we found to be around 12%. We arrived at this number by using the data in Exhibit 9 and 10. Weight of debt was found from dividing debt by debt plus market cap. Cost of debt was pulled from the bond ratings, and a cost of equity was calculated using CAPM and market risk premium of 6%. Net operating profit after tax was then found by taking the earnings before interest and taxes and multiplying it by 1 minus the tax rate. This helped us to find a terminal value of around 4,344. CapEx was then found by taking the difference between net PP&E of the current year and prior year, and then subtracting out depreciation. Change in net working capital was found by assuming a rate of 25.9% value and projecting out forward. This all contributed to the annual free cash flow each year from 2010 to 2014, and then a terminal value was found to be around 5517 using the model called the Gordon growth model with the terminal growth rate of around 4.8%. Finally, the enterprise value was found to be around 5206, which was done by taking the NPV of the sum of the total free cash flow for each year with a rate of around 4.8%. The equity value was found by adding in the excess cash flow and subtracting debt from the enterprise value. So, based on our analysis, we strongly believe that this is a great strategic fit for Oracle. We thank you, and we will now take this time for questions.